If I were to start all over again investing in the stock market, here's what I would never do. I would not pick individual stocks. In this video, I'm going to tell you why I have this recommendation, what I have learned over the years, the past 7 years investing in the stock market, and some of my key learnings from reading the book, the first 2 chapters of the book, Reboot Your Portfolio by Dan Bortolotti. Welcome everyone to another video on Momentum Finance channel. My name is Mo, a content creator, a DIY investor here in Canada, where I focus on investing for financial freedom through the power of index investing and low-cost diversified investing. Before walking into the depth of the video, I want to quickly show you the portfolio that my wife and I have, currently sitting at a total value of close to $643,000. You do notice that overall return for this portfolio is 21%. Now, this is the overall return over the past 7 years, which really results in a very lousy return. And that's something, and in fact, one of the key reasons why I'm a huge advocate for index investing. Approximately about 1.5 years ago to 1 year ago, I kind of transitioned my portfolio from stock picking and trying to outsmart the market and picking the winning stocks to truly focusing on ETF investing. And about a year ago, that's when I landed on these 3 ETFs that you see here on the screen. XEQT, which is iShares Core Equity ETF portfolio. It is considered an all-in-one ETF. XEQT consists of 4 other index ETF as part of its underlying holdings. Then we have some exposure as well to VT and VTI, both of which are in US dollars, Vanguard Total Stock Market Index Fund, as well as Vanguard Total World Stock Index Fund. Now, the reason I wanted to share this dashboard with you right off the bat is the fact that you do notice that within the past 1 year, how has these index funds actually returned for us? Anywhere between 11.8% to 13%. Now, keep in mind, over the times, we've contributed more to these funds. It's not like we invested all of the amount at one point. We gradually increased the funds. Some of them we bought later over the time, and some of them more recent. But all in all, it's a quite decent amount of return, I would say, within the past 12 to 14 months. And when you compare that to the overall return for the portfolio since the past 7 years or roughly so, it really starts to pinpoint why investing in index funds could have been a much better outcome for us had we started that way. But I don't want you to just take my words for it, which is why I'm going to share some of the key highlights of the book from the first 2 chapters of Reboot Your Portfolio by Dan Bortolotti. This book was recommended to me by some of the amazing investors that I've come across and known on Blossom app. For those of you who are not familiar, Blossom is an amazing community of investors here in Canada and US that come together, share their trades, talk about their investment journeys, and there is an amazing platform to learn and grow together, ask questions, and get responses from other like-minded investors out there. If you haven't checked it out, I definitely encourage you to do so. The referral link is in the description of the video. Now, with that out of the way, let's get into some of the key highlights from reading the book, Reboot Your Portfolio, that resonated with me. The book actually consists of 9 different chapters. It's called 9 Steps, as the title says, 9 Steps to Successful Investing with ETFs. Very much a book that I resonate with because, like I said, that's actually the approach that I've been following. But more so, I would say, based on the findings and what has been shared through it, it actually quite makes sense. It consists of 9 steps. Step 1 is stop trying to beat the market. Step 2, set your financial goals. These are the 2 steps that I want to highlight and share some of the key takeaways that I've read through this book. But other steps are find the right mix of stocks and bonds, fine-tune your asset allocation, select your ETFs, open your accounts, build your portfolio, keep it in balance, and stay the course. The focus right now is the first 2 chapters that I've already gone through and some of the key highlights that stood out for me the most. It is not just about how a company performs, but how it actually performs relative to what was expected of it. Many times you see the company reporting its quarterly earnings, and they do very well, both in terms of their earnings as well as in their revenue and net income. And still, the stock may, in reaction to that, go down. And this is truly indicating that fact that the performance is not really relative to what they report on, but more so as to what was expected of it. Because let's say the analyst and the market was expecting them to perform a certain way, and because they failed to meet or beat the estimates, that's why the stock is reacting a certain ways. Another key piece from this book is that publicly available information about a company does not give you an edge. And if you want to reliably outperform the market by picking stocks, you need to know something that has escaped the notice of everybody else, including those analysts and hedge fund managers who have access to a ton of resources to study stock, and based on that, make an informed decision on their part. More so as well, reliably picking stocks that will outperform the market is extremely difficult and unduly risky. And the evidence is overwhelming that most investors lack the skill and discipline to do so. There was also in the book references to Benjamin Graham as one of the greatest investors of all time, and how early on in his career, he talked about, picking the right securities and investing, but how late in his own life, Benjamin Graham actually acknowledged the challenges with stock picking, indicating, in the light of enormous amounts of research being carried on, I doubt whether, in most cases, such extensive efforts will generate sufficiently superior selections justify their costs. Another point to share is that index fund investors don't strive to be average investors. They actually indeed try to earn returns that equal the market averages. And there's a huge difference between these two ideas. Key difference being, if you indeed get to earn those average market returns, you're most likely going to beat majority of the other investors who fail to do so. In other words, over the long term, index funds offer the highest probability of achieving your investment goals. Now, on to the second chapter of this book, set your financial goals. A few things that resonated with me the most, a few excerpts from the book. A portfolio is not an end in itself. It's a tool to help you reach your life goals. The first step in improving your financial fitness is defining your goals and coming up with a strategy for achieving them. At the most basic level, achieving the financial planning process comes down to a formula with 4 inputs. How much money will I need? When will I need it? How much am I currently saving? And what rate of return will I need to reach my target? Here's an example of a simple financial goal. I want to build a nest egg of $500,000 by the time I quit working in 20 years. My portfolio is currently $80,000. I will contribute $5,000 this year and raise that amount by 5% annually. With those assumptions, I'll need an annualized return of 5.5% to reach my target. This goal is way better than saying, I want to save enough to fund my retirement. Think of your financial plan as a compass that will point you to the right direction, and not a detailed map that will tell you the exact location of every speed bump or hairpin turn along the way. While retired people say they need income from their nest egg, it is more accurate to say they need cash flow. After all, if you rely on portfolio to cover $2,000 a month in expenses, it makes no difference whether those dollars come from dividends, interest, or capital gains. Your retirement plan should start with the expectation that your withdrawals will be a combination of all 3. The author also recommends using a fee-for-service financial planner to review your own unique circumstances, your own situation, and develop a comprehensive retirement plan. They indicate that in most cases, paying for that fee-for-service financial planner pays for itself by preventing costly mistakes down the road. Almost no one becomes rich because they earned market-beating investment returns. They get wealthy primarily because they spent less than they earned and invested their savings wisely. Keep in mind that investing at a young age allows your money to compound for more years. It also establishes healthy habits early in your career. Make your savings a fixed expense too. In other words, be sure to pay yourself first, and you'll be well on your way to meeting your investment goals. DIY investors who compare the MER of different portfolios almost always ignore the added complexity and transaction costs that come up with supposedly cheaper options. How I reflect on this point is that I read on Blossom people talking about, well, if you're investing in XEQT as an example, as a fund, only one ETF, and it has the MER of, let's say, 0.20%, you'll be better off if you were to just invest separately in each one of the 4 underlying ETFs that XEQT has. Truth of the matter is, yes, indeed, that is the case. In fact, the weighted average MER for those funds separately will be less than what I'm currently paying for XEQT on its own. But keep in mind, it's just going to make things a lot more complex for me. Whereas right now, investing for me is super simple. I've already set it on autopilot every day, investing a certain amount of dollars that I'm comfortable with directly into XEQT without having to worry anything, without having to actually lifting a finger, making things super simple. I think that's why this piece from the author's book really resonates with me. Especially, I think early on, it really doesn't matter. The MER difference is so minimal that it's minuscule that it's not going to make much of a difference. That says, keeping costs low should always be a goal at every age. But the truth is, if your portfolio is less than 6 figures, small difference in fund fees matter a lot less than you think. And instead, you're better off focusing on spending less than you make, saving the difference, and investing with low cost, diversified index funds. The reason I shared these key excerpts from the book was that those are the ones that really, really resonated with me. And I jotted them down just so that I can come back to them and refresh my memory on the book. I highly encourage you reading this book, especially if you're a new investor or somebody is kind of on the fence of whether ETF investing through index fund is a path for you to consider. I think it gives you good kind of insights. And hopefully, as you self-internalize it, it's going to add a lot more value to you and your investment journey. Hopefully, I didn't really spoil it for you. I tried to really share a few key excerpts that stood out for me the most, and some of my internalization, as I shared here and there as I was going through these notes with you. I would love to hear from you. If you have read this book, do share with me some of your thoughts and key learnings. And if you haven't, what were some of your thoughts and reflection on what I shared so far based on the key excerpts from this book? I would love to hear from you. Do let me know in the comment section. With that, thank you so much, everyone, for watching this video. I hope you found it beneficial. I appreciate it if you give this video a thumbs up, if that's something that added value to you and you gained some insight, as well as following our journey, both on Blossom as well as on YouTube channel through following Momentum Finance. Thank you, and I hope to see you all next time.